If you're a technology firm looking to get a business valuation completed, it's critical that you're not using a one size fits all approach on determining your EBITDA multiple. Whether you're a managed IT service business, cybersecurity, fintech, software development, or you're in the hardware business, there's a huge difference in your multiple depending on what your niche is within technology, whether you're high growth currently, whether you're steady state and you've been in business for over 10, 15 years, or if you're a technology company in a declining part of the industry. It really changes the EBITDA multiple, and you have to work with an analyst that understands market comparables and understands the different levers that a buyer is going to use to determine whether your company gets a 3x multiple or a 12x multiple. So the key things that an analyst will do to perform the valuation is there's a number of inputs. So the first couple are all financial and they're all hard data. So 5 years financial statements, profit and loss, and balance sheet. And then there's going to be a lot of information about who your customers are. So revenue by customer by year, what your customer acquisition cost is, what your lifetime value of your customers are, and what your churn rate is. Another key thing is how your contracts work with your customers. If you receive money once and never see your customer again, your multiple is going to be lower. If they're on a subscription basis and you have monthly recurring revenue and annual recurring revenue and a low churn rate, your multiple is going to be higher. Depending upon your industry, within the overall technology space, you could have intellectual property or trade secrets. And these are another key thing that's going to boost your multiple higher. Buyers are not going to want a technology company that is reliant upon the owners or key employees that are near the end of their working life and ready for retirement. So being able to provide an org chart and showing a middle management layer that a new owner can, take the keys of the business, the gas is full, and the business can run on day one is critical to getting a high valuation. And the last thing is, you probably have a number of partners and key vendors, and these are things that, could be a big risk to the new owner. And so this type of information needs to be disclosed, or what are those key risks for the business to operate successfully in the future. So there's a lot of considerations for a technology business valuation. And I would encourage you to start thinking about it early if you're thinking about it at all. And so we'd love to help. You can contact us at info@exitequity.com at any time. And we can talk about what the future looks like and what evaluation looks like in the current market.